Okay, so we're all told to obsess over our credit score, right? But what if that three-digit number isn't the whole story? Well, today we're going to pull back the curtain on the entire credit system, from the report that tracks everything to the score it creates, so you can finally understand what lenders actually care about. Let's get into it.
So, is that three-digit number you see on your banking app the only thing that matters? Well, the short answer is no, not even close. Because what lenders are really looking at, it's something much, much deeper. Just think about this for a second. It's kind of like a paradox. You have two people, both with the 700 credit score. Person A, they've got this long, stable history, and bam, they get approved for that loan. Then you've got person B. They've maxed out their cards, just opened a bunch of new accounts, and they get denied. Same exact score, totally different results. So what gives?
It's because that score, it's just the tip of the iceberg. It's a symptom, not the actual cause. Lenders, you see, they don't really care about the symptom. They want to investigate the source. They're going to dig into your entire credit profile to understand the story behind that number. And that's exactly what we need to do too.
All right, so if we're going to understand credit, we've got to start with the foundation, right? And that's your credit report. And honestly, the best way to think about it is like it's your own personal financial file cabinet.
Okay, first things first, and this is super important. A credit report is not some kind of judgment on your character. It's just a data file. Think of it as a totally neutral record of how you've handled money over time. Lenders just open up this cabinet to see your history. That's it, plain and simple.
So when you open that cabinet, you're going to find four main folders: your personal info, your inquiries, and any public records. But listen, the absolute heart of your entire profile, the part that tells the real story about how reliable you are, is that accounts section. That's the one to watch.
Okay, so we've got the report, right? The file cabinet full of all our data. So how does all that stuff get magically turned into that three-digit number everyone is so obsessed with? Let's take a look at the recipe.
So the scoring models, like FICO for example, they use a pretty consistent recipe. But here's the key. The ingredients are not all created equal. You've got two factors that just dominate everything else. Your payment history, that's a whopping 35%. And then this thing called credit utilization, which is 30%. You add those up, that's almost 2/3 of your entire score right there.
All right, let's really zoom in on those two heavy hitters. Payment history, it's actually pretty simple. Did you pay your bills on time? I mean, that's the ultimate signal of trust, right? And then credit utilization. This one's asking, hey, how much of your available credit limit are you actually using? A low number tells a lender, yep, I'm in control. But a high number, that kind of screams, whoa, I might be a little overextended here, maybe relying too much on debt. Okay, so we get what the report is, and we know how the score is put together. Now let's get to the most important part of all of this. How do the things we do every day, our real-life actions, create the patterns that lenders are actually looking for?
There's this quote that just nails the absolute core of how credit works. It's this: credit responds to patterns, not intentions. See, the system, it doesn't know you had a tough month. It doesn't know you meant to pay on time. It only sees the data, the pattern. And what that means is one good month can't just erase a bad pattern. But hey, the flip side is true too. One bad month isn't going to completely wreck a long history of good ones.
So think about it. Every single thing you do sends a signal. On one side, you've got these really powerful trust signals. Paying on time, every time. Keeping your balances low, totally under control. And just letting your accounts get older, which shows stability. And then on the other side, you've got the risk signals. Missed payments, maxing out your cards, opening a whole bunch of new accounts really fast. All of that stuff signals urgency, maybe even a little chaos.
Okay, let's talk about a classic mistake, one that so many people make. You know that old credit card you've had forever but never use? The question is, should you close it to clean up your profile and, just simplify things?
Well, the answer is almost always a hard no. Remember those scoring factors we just talked about? See, closing that old account can actually hurt you in two big ways. First, it can drag down the average age of all your accounts, which dings your length of history score. And second, and this one's a biggie, it totally removes that card's credit limit from your overall available credit. And what happens then? Your credit utilization percentage can spike, just like that.
So, after all this, what's the real goal? What are we actually trying to do here? I'll tell you what it's not. It's not about chasing a number or finding some secret hack. The real goal is to build a stable, predictable financial profile, one that a lender can look at and just trust.
And you know what? The path to get there is actually pretty simple. Step one, you've got to understand your credit report.
That's your raw data. Step 2, decode how all that data gets summarized into that score. And finally, step 3, you master the consistent behaviors, the daily habits that create a positive pattern over time. That's it. That's the whole game.
You know, a truly strong credit profile, it isn't flashy. It's not complicated. It's calm. It's consistent. In fact, it's kind of boring, and that is the best thing it can be. Because in the world of credit, boring means predictable, and predictable means trustworthy. So look, if you take just one thing away from all of this today, let it be this. Stop chasing the number. Instead, focus on building the foundation. Build a stable profile that proves you're reliable month after month, year after year. That's what earns a lender's trust. That's what gets you the keys to the car, the mortgage for the house, whatever it is you need.
So I'll leave you with one final question to think about. Take a hard look at your own habits. Is your credit profile being built for long-term stability, or is it built for short-term speed? Honestly, the answer to that question, it's going to define your financial future.